Over the last 48 hours, the cryptocurrency market witnessed one of its sharpest weekend pullbacks in months. Bitcoin, the leading digital asset, dropped roughly 7%, Ethereum lost nearly 6%, and Avalanche, which had been leading an impressive rally earlier this month, fell by close to 10% in just a few hours. It was fast, brutal, and for many traders completely unexpected. What we experienced is what analysts call a flash crash, a sudden, sharp drop in prices across multiple cryptocurrencies, often triggered by a mix of technical and psychological factors. But what actually caused it this time? The answer lies in a combination of leverage, market sentiment, and macroeconomic pressure converging all at once. The first and most immediate trigger was a wave of liquidations. According to data from CoinGlasses, more than 350 million worth of leveraged long positions were liquidated across exchanges in less than 24 hours. When traders borrow funds to amplify their positions, betting on prices to rise, they expose themselves to forced sell-offs when the market turns against them. Once these liquidations begin, they cascade through the system. Each liquidation pushes prices lower, triggering even more liquidations, until the market violently resets itself. This chain reaction is exactly what unfolded, a domino effect that caused a sharp plunge in asset prices. But leverage was the only factor at play. We also saw a decline in spot buying pressure alongside a sharp spike in exchange inflows. This means more traders were transferring their crypto holdings onto centralized exchanges, a common behavior when they intend to sell or hedge their positions. In other words, the crowd began to panic. What started as a small wave of automated liquidations quickly turned into a broad sell-off, fueled by fear and algorithmic trading systems. Zooming out, this flash crash didn't happen in isolation. It's part of a much bigger story unfolding in the financial world. The recent U.S. Consumer Price Index (CPI) report showed that inflation was slightly higher than expected, which immediately reignited fears that the Federal Reserve might hold off on cutting interest rates. The market had been pricing in optimism for looser monetary policy, but that sentiment took a hit. When inflation refuses to cool, the dollar index DXY tends to strengthen, and that's exactly what happened. A stronger dollar puts downward pressure on risk assets like stocks and cryptocurrencies because it often signals tighter global liquidity conditions. Adding to this mix, we've reached the final quarter of 2025, a time when institutional investors traditionally rebalance their portfolios. After months of strong gains driven by AI stocks, tech sector growth, and the excitement surrounding blockchain innovations, many funds are taking profits. And whether we like it or not, crypto remains a risk-on asset class in the eyes of big money. That means when institutions reduce risk exposure, Bitcoin and Ethereum often feel the pressure first. Another contributing factor was the recent slowdown in ETF inflows. Bitcoin ETFs, which were the talk of the financial world earlier this year, have now seen 2 consecutive weeks of outflows. Nearly 150 million in redemptions took place, showing that some short-term investors may be rotating out to capture profits. While this doesn't mean institutions are abandoning crypto, it does suggest that near-term enthusiasm has cooled. However, it's important to emphasize that long-term conviction still remains strong. Major financial firms like BlackRock, Fidelity, and AQK continue to expand their crypto-related infrastructure, and that is a bullish sign for the bigger picture. Now let's dive into Bitcoin's technical picture, because that's where things get particularly interesting. Bitcoin was trading around 66,000 before the crash began. Within hours, it plunged to 61,500, which just so happens to be a key support level that dates back to late August. The dip was sharp, but what came next was equally important. Buyers stepped in. According to on-chain data from Glassnode, whale accumulation, that is, wallets holding over 1,000 BTC, increased by nearly 2% right after the dip. When large holders start buying during panic, it's usually a sign of confidence that the correction is temporary. It's what seasoned investors refer to as buying the fear. Still, caution is warranted. Bitcoin needs to reclaim the 65,000 level for a meaningful recovery confirmation. If it can't, and if the price closes below 60,000, we could be looking at a deeper correction that may test support around 57,000. Historically, these shakeouts serve a purpose. They flush out weak hands, reset funding rates, and clear the path for healthier long-term growth. So while the short-term charts might look scary, the structure of this move doesn't necessarily point to a long-term breakdown. The Alcon market, however, paints a slightly more volatile picture. Starting with Avalanche AVAX, one of the hardest hit top coins this weekend, the price fell by over 10%. Yet despite the drop, the underlying fundamentals of the network remain stable. Developer activity is still strong. Total value locked TVL in its DeFi protocols only declined slightly, and daily active wallet counts have not fallen dramatically. This indicates that what we're seeing is more of a speculative panic rather than a structural problem. Long-term investors in AVAX might even view this as a discount entry point rather than a red flag. Ethereum ETH, meanwhile, slipped below the crucial 3,000 level, a price zone that acts as a strong psychological marker for traders. But even as prices dipped, the network's gas fees and staking inflows remained steady. That's a positive sign, because it shows that Ethereum's on-chain utility didn't suffer despite the market turbulence. Whales did not dump their ETH holdings, and that speaks volumes about confidence in Ethereum's role as the backbone of decentralized finance. Several smaller cap altcoins also faced significant corrections. Projects like Solana SOL, Render UNDU, and Fetch AIFET each saw losses between 8–12%. But these tokens remain some of the most innovative in their respective niches. Solana continues to dominate the high-speed blockchain narrative, Render remains a leader in decentralized GPU rendering, and Fetch AI is carving out a space at the intersection of artificial intelligence and blockchain technology. These are precisely the kinds of projects that tend to recover fastest once broader market sentiment shifts back toward optimism. Speaking of sentiment, let's take a closer look at what the on-chain and behavioral data are telling us. The Bitcoin Fear and Greed Index, which measures investor sentiment based on volatility, volume, and social media trends, plummeted from a greed score of 72 to a neutral reading of 45 within just 2 days. Historically, such rapid declines often coincide with local bottoms, as fear replaces euphoria and short-term traders rush to exit. Exchange inflows spiked during the sell-off, confirming that many investors moved their holdings to exchanges to sell. Yet interestingly, cold wallet accumulation, meaning long-term holders moving coins off exchanges, also increased. That's typically a bullish mid-term signal, suggesting that while retail traders panic, experienced investors are quietly accumulating. Across social media, the conversation shifted dramatically. Hashtags like CryptoCrash, Sell, and Bearmark started trending on X, formerly Twitter. Influencers and traders flooded timelines with panic posts and bearish takes. But seasoned observers know that this type of collective fear has often preceded strong rebounds in the past. In fact, we saw the exact same sentiment pattern before Bitcoin's major reversal in early 2024, when BTC was still trading under $40,000. The emotional cycles of crypto markets repeat themselves time and again, and those who recognize the pattern often end up profiting from it. Flash crashes are not new to crypto. They're part of the asset class DNA. We've witnessed them many times before, from the pandemic crash of March 2020 to the May 2021 leverage meltdown to August 2023's DeFi correction. Each one looked terrifying in the moment, but nearly all were followed by substantial recoveries in the months that followed. The reason? Crypto is still a young, volatile, and highly reflexive market. It overreacts in both directions. If history is any guide, this current flash crash might actually be setting the stage for the next major bullish leg, especially if Bitcoin can hold its higher lows on the weekly timeframe. And here's something even more encouraging: there's no evidence right now of long-term structural weakness. Institutional interest remains firm, and capital inflows into blockchain startups and infrastructure projects continue to grow. Firms like BlackRock and Fidelity are not just investing in cryptolets, they're building entire financial ecosystems around tokenized assets and digital custody solutions. Developers are still innovating at a rapid pace, and new narratives like real-world assets with AI-integrated DeFi and layer to scalability are attracting both venture funding and community excitement. In short, the underlying fundamentals of the crypto market are stronger than ever, even if the price action feels painful in the short term. So, where do we go from here? For Bitcoin, the critical range to monitor remains 60,000 to 65,000. If BTC can hold this zone and break above $65 with strong volume, it would confirm a return to bullish momentum. On the downside, a close below $60 could invite further testing of lower supports, but even then, the macro structure would remain intact as long as Bitcoin stays above $57. For Ethereum, reclaiming 3,100 would mark a solid recovery, potentially opening the door for a retest of the 3,400–1,500 range. As for altcoins, rotation patterns are worth watching closely. Historically, after major Bitcoin corrections, funds tend to flow back into high-conviction altcoins once stability returns. Tokens like Avalanche, Solana, Render, and Fetch AI could be among the first to bounce, especially as their ecosystems continue to grow. On the macro front, investors should keep a close eye on upcoming Federal Reserve statements and inflation reports, since these remain the biggest short-term drivers of volatility across all financial markets. The key takeaway here is simple: volatility creates opportunity. Every major crypto bull run in history has been built on the ashes of a panic-driven correction. The market needs these resets to clear out leverage, shake out weak hands, and build a stronger foundation for the next move up. Long-term investors who can look beyond the noise tend to be the ones who benefit the most. So, as we wrap up this weekend flash crash update, remember this: the crypto market moves incredibly fast, and emotional reactions can often do more damage than the crash itself. The smart play right now isn't panic selling, but staying informed and analyzing the data calmly. Understand what's noise and what's signal. On-chain metrics, macro trends, and network activity all matter more than daily headlines. If you found this breakdown helpful, make sure to hit that like button, subscribe for more detailed crypto market analysis, and drop your thoughts in the comments. Do you think this was just a short-term dip or the start of a bigger correction? Thanks for tuning in, and as always, stay sharp, stay informed, and remember, in every crash lies the seed of the next rally. I'll see you in the next update.